Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. Good morning, Tyler. How are you?
Good morning, Dean. I'm doing well. How about yourself?
Good. Thank you. Today we're going to talk about a topic I think a lot of people are concerned with or want to know more about, and that's market volatility. Okay? And anytime you talk about market volatility, people go back to thinking of 2008, the Great Recession, and what happened with the market crash there. We're going to look at 2008. We're going to compare that to today's market volatility, see any similarities, see some differences. But to get things started, let's look at what created the 2008 market downturn, which led to a recession, as people refer to it as the Great Recession. First of all, in 2008, the S&P 500 lost about 37%, which was pretty significant. And really the triggering effect that started this collapse was there was a collapse in bank lending subprime mortgages. There was a lot of people who were really hurt by the mortgages that were granted to them. There were stories of couples making $40,000 a year in combined income and getting approved for a $400,000 to $500,000 mortgage. Well, if you sit down with a calculator, you're going to figure out that's not going to work. But a lot of people didn't sit down with a calculator and they just accepted the mortgage and unfortunately defaulted. So a lot of that happened as a result of the subprime mortgages. It led to other things happening, such as bankruptcies and closures of pretty large financial institutions. I mean, back in 2008, a pretty common financial institution with commercials running all the time was Dean Witter. Also, Lehman Brothers was very significant in the financial industry, and they're gone. So, we saw some triggering effects, starting with subprime mortgages, led to bankruptcies and closures of financial institutions. And then we also had government bailouts. So we were in over our head. 2008 was a perfect storm, which led to that market decline. So, what we're going to do is look at 2008, and then we're going to go through, 2017, 18, and so on. Tyler, what else about 2008 is important to know?
Yeah, Dean, and as you said, in 2008, the S&P 500 lost 37%. So that was from January 1st all the way through December 31st. So for the year, it was down 37%. But keep in mind, from going back to late 2007, so in October of 2007, at that time, the market had hit an all-time high. And then from that high point, the recession happened throughout 2008. And then in early 2009, in February to March of 2009, the market actually bottomed out and hit the low point then. So from the high point in 2007 to the low in early 2009, the S&P lost almost 60% from that high to the low. So that's a huge, huge downturn. You lost over half your portfolio if you were fully in an index fund. So I just wanted to kind of put that in perspective to people who are listening, and a lot of listeners already know they had been through 2008 with their own 401k, their IRA, their portfolio. So it was a really big downturn in 2008. And like Dean said, one of the primary reasons for that collapse is banks lending subprime mortgages. So those are mortgages, they're lending out mortgages to people who can't afford to pay them. And starting in 1999, the Federal National Mortgage Association tried to make home loans more available to those people who couldn't pay them, those who had lower savings or bad credit, so they could achieve the American dream of home ownership. At that time, the late 1990s, the early 2000s, what many of the mortgage associations considered the American dream was owning a home. Now I'd argue that the American dream could be being debt-free, but I guess the American dream, it might have a different definition for a different person. But at that time, it was home ownership. That's what the National Mortgage Association termed it as. So American dream is home ownership. what happened then is banks were trying to lend these mortgages to people who couldn't afford them. So borrowers who had bad credit couldn't pay their mortgage. Just like the example you used, Dean, there could be a couple that made a combined income of $30,000, $35,000 a year, and they were getting approved for a $500,000 mortgage. So as you can see, that really isn't going to work. And those people with those big mortgages, they weren't able to make the payments. But the banks, they continued to give out those mortgages simply because they could charge higher interest rates on borrowers for subprime mortgages. So initially they were paying that mortgage, but then after a couple years, they could no longer make the payments on that. That's when borrowers had defaulted, and those mortgage defaults then led to bankruptcies and eventually government bailouts, which is what happened. The AIG and different large lending institutions, they actually had to be bailed out by the government. And then that led the economy into a very poor state at the time. Whenever you have government bailouts, you have big banks failing. That's definitely not good for the economy. So that was a quick little synopsis there of 2008 and what kind of led to that recession, with the main thing being the housing crash through subprime mortgages.
Okay, so you look at 2008, 2009, you're starting to come out of the deep trough that we were in with the market. We were now in a recession, classified properly as a recession. So the government wanted to intervene and keep the financial arena thriving. So the stock market was propped up with the sale of bonds. Okay, the government was buying bonds, which was propping up the stock market. Sounds good, but as the years started going on, we found out that the economy really wasn't taking advantage of that. There still wasn't a lot of spending. Consumer confidence was at an all-time low, even though interest rates were at an all-time low. So it really wasn't working. So what happened then is in 2014, a process called quantitative easing really happened. Okay, it really ended in 2014, and that was the bond buyback that the government was doing to prop up the stock market and the financial institutions started that spigot was being turned off. And what that means is the bonds were being reduced as far as how many were being purchased each and every month. And that led to a relatively stale market. So we look at 2015 and 2016, we didn't see a lot of volatility in the market, but we really saw a pretty boring market. And we saw an economy that wasn't spending any money. So we painted ourselves into a corner with low interest rates, which did not stimulate the economy. But yet the market was relatively strong but boring. So what happened in 2015 and 16, this is where, as an aside, a lot of investors started to find out how much they were paying in their portfolios, because if you have a market that's giving you a 1% gain and you're seeing a 3% loss in your portfolio, unfortunately, that's typically an indication of internal fees. So people are really scrutinizing. So that's actually a good thing that happened with the stale market in 2015 and 16, is people saw the type of fees that they were starting to pay because they weren't making anything in a sideways market. So the quantitative easing, the bond buyback by the U.S. government was being turned off, led to, like I said, a pretty stale market in 2015 and 16 until the end of 2016. And then we saw the election. President Trump was voted in, and the market took off. Okay, so in November of 2016, the market took off. People referred to it as the Trump bump. Some people in 2018 are now referring to the market as the Trump slump because of some of the things that are happening with our administration. But if we look at what happened in 2017, it was unprecedented. We went an extended period of time, over a year, without having any type of correction at all. It was really not the normal at all, 2017. What we're seeing in 2018 is much more normal than what we saw in 2017. But as a result, a lot of people decided they were going to go all in their portfolios in 2017. And, you know, there's a saying in the financial industry that there are three main emotions. It's hope, greed, and fear. And unfortunately, they all overlap. And what happened in 2017, it's not necessarily to be construed as negative, but it's human nature, and greed took over. And we had people who were in their 60s, fully retired, wanting to be 100% in the stock market to take advantage of it, which is a dangerous thing to do, because a lot of people don't really know the basics or the fundamentals on how the stock market really works. They think that if the market starts to go down, you can sell positions and add some protection. Well, what happens in after-hours trading, or what happens when the futures go down substantially? You come into the office, you go to your workforce, and you see that the market opens 20% down. Well, if you're carrying all equities and all stocks in your portfolio and you're 20% down, you're just riding the wave. Okay, that's why we still say, even in 2017, we wanted to have bonds in portfolios. Part of the reason is bonds are boring. They really are, but they're efficient when it comes to adding protection. They act as a shock absorber to the volatile nature of stocks in a portfolio. So if you come in and futures are down and after hours trading, push the market down 15 or 20%, at least when you come into the office, there's an opportunity, if you're self-advising or if your advisor's working with you, that you can sell bond positions when the timing is right to be able to open up some cash to buy low and get out of the hole. So 2017 actually created some poor habits with investors. We say even in 2017, it was very, very, very important to hold cash in the portfolio. So now let's look at 2018 and what's creating the volatility. We set the stage. We talked about 2008 through 2017. 2018 is a little bit different creature. We're looking at social media driven items that are really affecting the market. A tweet in the morning can make the market drop 3%. A tweet in the morning can make the market go up 3%. That's the type of market we're in right now. Typically, when you have social media driven market or geopolitical issues happening, such as potential sanctions, tariffs, and trade war, those directions that the market goes, whether up or down, are usually short-lived. Okay, they usually spike pretty significantly. I go back a couple years when the Brexit vote happened. The market absolutely dropped very quickly, and the very next day it recovered and built off of a gain. So those are things that happen quickly. Tyler, what else in 2018 are we seeing that really affects the market?
Yeah, Dean. So like you had mentioned, in 2017, the market was heading about as straight up as it could go, or as it had gone over time, and it was very economically strong. There was added jobs, and the global economy was also doing very well. And like you said, that's where greed starts to creep in, and people want to be invested in all stock portfolios. There were people in their 70s and 80s who were inquiring about taking their portfolio and converting it into an all stock portfolio, which really wasn't the right thing to do, because then, as we see now in early 2018, a positive market doesn't last forever. And it was about as straight up as it could go from late 2016 to all the way through 2017. And then in February of 2018, it's been very volatile, and it still is now ever since. And so we see now in 2018, the stock market is reacting really to the political climate that we're in. That's why it's going up and down and all over the place, is really due to a lot of political chatter. And it's also volatile due to fears over, first off, it was inflation and potential interest rate increases. This was back in early February when it really started to begin. The volatility started to begin because there was just a jobs report that came out, and it said that the jobs were being added, wages were going up. So it's a good thing, economically speaking, but the market feared that would drive up inflation, because more people are working, more people have jobs, more people can buy different products. So the demand for different goods and services are going up. So that drives the supply up, which is inflation, the prices of goods and services going up. And with inflation, interest rates also go up. So if inflation goes up, what the Federal Reserve does is they'll increase interest rates to try and counter inflation, because if you increase interest rates, that means that there's going to be less people buying. Not as many people are going to want to buy that mortgage if they have a higher interest rate, or they're not going to want to buy that car at a higher interest rate. So less people are buying, but then interest rates also go up on different types of savings vehicles. So your savings account you might be getting a little more interest in that, or CD rates or fixed annuity rates. So interest rates of different types of safe investments are also increasing. So when people see that, they're going to sell out of the market, out of stocks that they perceive as more risky, and go into a safe investment now that they're finally potentially going to start paying some interest. So that happened. Stocks kind of sold off over the fear of inflation. And then in addition to that, there's been the tariffs that were imposed on China. Then China kind of fought back and said, well, we're going to impose tariffs on the U.S., and now there's a potential trade war looming. The market doesn't like that either. Whenever you hear the term trade war, that can affect companies' profits, their bottom line, which can eventually affect the economy that way. And then in addition to that, like Dean had mentioned, just with all the political chatter, President Trump might tweet something that the economy might not like, that a stock like Amazon recently might not like. He's been tweeting at them. So that can also affect the market. But ultimately, if you take 2008 and compare that to 2018, where we're at now, the fundamentals of our economy are strong right now. Companies' earnings and their revenue continue to increase each quarter, and that's what drives the economy. That's what drives the market. And banks aren't lending out subprime mortgages like they were a decade ago. You have to go through, you have to get approved, and there's different types of financial regulations that are preventing them from doing so anyway. But really, in 2008, there was things going on that led the economy into a very poor state. In 2018, what's leading the market up and down is more so political chatter and not the underlying economy, because that is strong right now.
Good point. And there's one other item here. If you're on Social Security, or if you're looking to retire and planning out your Social Security, you should be very happy with what's happening in 2017 and 18. Unemployment rates are at all-time lows. More and more people are working right now. So how does that affect you as a retiree or a pre-retiree? That means you are getting more Social Security money into the Social Security Trust Fund than has been done in the last 5, 6, or 7 years. So that is a really good thing for our Social Security situation, is having more people work, more money comes out of that payroll. It funds the trust fund for those people who are retired and drawing Social Security. Okay, before we go on to next topic here, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions, located on Allied Street in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, to continue, we're going to talk about things such as the fundamentals. As Tyler said just before our break, fundamentals are very, very, very important when we look at the economy in 2018. People want to know what we think, how the market's going to do. There's a lot of volatility, but it's based mainly on political chatter. It's based on geopolitical issues, social media issues, but the economy itself is performing very, very well right now. And one thing that's happened that we haven't seen in a number of years is the global economy is very good. Emerging markets are doing very well. International markets are doing very well. It's hard to really pick out a certain part of the world that's not performing well or stable. So this is a time, it's almost unprecedented. Again, I think because of that, some people are always sitting back on their heels a little bit, waiting for the next, quote, big crash. I don't think you should sit back and wait for a market decline. I think you should always be prepared, though. Again, you want to have the boring bond positions in your portfolio so they can be liquidated to get you back in the market if the market goes down. And also, we are a firm believer, hold some cash in your portfolio because there's always a buying opportunity. We're seeing right now with the volatility, some really nice stock go down 10 or 15% due to whatever reason, which does create a buying opportunity if you're an investor. So there are things that are happening. The global economy is good. And really in 2018, we haven't even seen the benefits of tax reform yet. Tax reform was built into the market at the end of 2017. The market was really very strong as a result of what could happen because tax reform is going through. And at the beginning of the year, you heard some companies offering one-time bonuses or increasing their minimum wage, which is wonderful. But we haven't even seen money come back into the United States as a result of bringing tax numbers down. It's called repatriation of dollars. So those companies who are investing overseas are incentivized through a reduction in taxes to bring that money back to the United States to reinvest in their own facilities and workforce. So we think we're going to start to see that more towards the third and fourth quarter of 2018. We also have a potential infrastructure rebuild that would happen in 2018. For the first time in decades, there's going to be a major investment back into the infrastructure that built the United States. And that is almost exclusively a U.S. initiative. And what I mean by that is it's going to be for the labor force here in the United States predominantly, and many of the companies that create the machinery that are going to be working and preparing and helping with the infrastructure rebuild, many of them are U.S. based, such as Caterpillar, John Deere, Cummins Motors, Pierce. There's a lot of things that are happening here economically that we think are going to lend to a good year in the market in 2018. However, there is going to be this type of volatility throughout the course of the year.
Yeah, Dean, and when we talk about market volatility, it's important to touch on how the stock market is driven by fundamentals because they're strong right now. And according to FactSet, earnings for S&P 500 companies are expected to grow by 16.8% in 2018. Now, that's not the S&P 500 itself, but that's company earnings, which is what we expect to see. As long as those are growing, that's what drives a healthy economy, which in turn drives the market. And really, the earnings for companies are expected to grow due to primarily three factors in 2018. Number one being positive global growth and momentum, the effects from tax reform, and the additional jobs that are being added under the Trump administration. So really, a lot of analysts project 2018 to the economy to continue to grow, which is a good sign for the market. But one other thing I wanted to point out, and it's very rare, is that global growth in 2017, every major country or region grew. So everything from China to Europe to Latin America to Japan, every major region grew in terms of economic growth, and that's very rare for that to happen. So really, in 2017 now, the international economy finally started to signal its recovery from the 2008 recession. And that tells me two things. Number one is that in 2008, after the recession, the global economy was hit even twice as hard as the U.S. economy, believe it or not. And then number two, if it's finally starting to catch up to the U.S. economy, that tells me that it has much more room to grow as well. So that's why you want to be diversified and make sure that you have a portion of your portfolio in the international market right now, because that seems just as poised for growth as the U.S. market does. And keep in mind that the international economy, many people might be thinking, well, that's overseas. What does it have to do with us and the U.S. economy anyway? Well, many U.S. companies sell products to those countries, which helps boost the profits of the U.S. companies when the international markets are healthy and they're able to buy goods back from the U.S. And so international companies being in a good state can also help the U.S. economy and the U.S. market be in a good state as well. So ultimately, a lot of the market volatility right now has been caused by the political chatter and speculation, and as we just outlined, not the underlying economy, because fundamentals are doing strong. So it's not by an underlying economy that's doing poorly, which is important to keep in mind.
Okay. Also, I think it's really important that people understand when you talk about market volatility is that drawdowns are very common. Okay, in 2017, that was very uncommon. We did not see a drawdown. Again, 2017 was out of the ordinary. 2018 is more of a common situation in the market. As an example, since the 1900s, the Dow Jones has experienced 22 drawdowns of greater than 20%. Okay, think of that, 22 drawdowns of greater than 20%. We're seeing drawdowns now go as deep as 11%, and then we recover back to almost even, and then go down 11%, and then back to almost even. And people are very, very worried and concerned about that. Yes, we should be concerned, but we should be educated and know how we would react. Have a plan, okay? Be diversified, even outside of your stock portfolio or your mutual funds, bonds, and so on, whether that's real estate or insurance products, look at them. But also remember that those 22 drawdowns of greater than 20%, they range from 21% to 89%, but the average is 37% in a drawdown. So actually, they're relatively common. Tyler, what else about, the drawdowns that are more common than not?
Yeah, Dean, and like you said, since the 1900s, the Dow has experienced 22 drawdowns of greater than 20%. And those drawdowns, so drawdowns the size of 20% or more, typically occur 1 to 3 times per decade. So that, once every 1 to 3 times every 10 years, historically, we'll see the Dow Jones decrease at least 20% or more. Now, one thing that everyone should keep in mind is that we haven't had one single drawdown of that size yet in the current decade. So from 2010 all the way up until now, the Dow hasn't dropped 20% or more once yet. So that just kind of shows that we've had an extended recovery. We haven't really seen that volatility. So again, we're seeing it now, and it could happen just because we haven't had that yet this decade. And also short-term drawdowns of 5 to 10% are even more common, and those typically happen annually. So short-term drawdowns like this, we've seen a drawdown of 11 to 12% with the Dow from the most recent high. That actually happens annually. They're more common than people think, but we're not used to them because in 2017, we haven't had one day where the market declined 5 to 10% from its recent high. So that's where a little bit of recency bias kind of comes into play. And investors for the last year and a half, from late 2016 through early 2018, we haven't experienced that volatility. So now that it's here, we kind of have that recency bias. We're used to a market that's headed straight upward. We don't know what to expect. It's a little different because now that we're finally seeing the market go up and down and all over, it's something to get used to. But really, this volatile market, we expect that to be the new norm, so to speak. And that was really the normal all along, but people just aren't used to it because 2017 was about as upward as a market can go. But always remember to stay the course and stick to your financial plan. So during times of market drawdowns, you don't want to make knee-jerk emotional reactions and buy and sell based on short-term market swings and try and time the market or anything like that. You always want to take a long-term approach.
Okay, and one last thing is don't try to time the market. Again, our philosophy is time in the market, not timing the market. Building up cash and taking gains are very important to do. It's part of putting together a good financial portfolio, but that is different than trying to time the market. You'll find out when you look at things like that, since 1927, the S&P has never lost money over a 20-year holding period. So depending on how late you are in your retirement planning, it can come into play where you want to take your gains, build up cash. If you're younger, you want to stay the course. Okay, that's all the time we have this week, folks. See you later and hope you'll join us again next week.
We'll see you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.